Hi, this is Cindy again, and we're going to wrap up Module 7c with the accounting changes. Now, it really helps because changes in accounting principle, it is hard, okay? I do admit, it's hard. But when you actually do a change in accounting principle and you change what is going on with like the income statement and how you recast the statement, sometimes it really helps when you do this, okay? And I picked this one because it's a really good one, although remember, you have to correct that typographical error. Now, what you're going to do is when they give you the old method, you're going to use some information from the old method to help you solve for the new method. And this is our standard formula for calculating cost of goods sold when you're dealing with inventories. And under the weighted average method, the average cost they gave us for the ending inventory was $5,000 and $9,000 for the ending inventory. So ending inventory was $5,000 and $9,000, okay? And this is a standard formula. You take the beginning inventory plus your cost of goods purchased. This is your purchases. That gives you your cost of goods available for sale. You subtract your ending inventory, and that gives you the cost of goods sold. So I plunked in the numbers for the ending inventories of $5,000 and $9,000 for 2007 and 2008 under the average method. Now remember, the ending inventory in 2007 becomes the beginning inventory for 2008. Now, they didn't tell me anything about, what's the beginning balance or what have you. I do believe they probably tell you that they just started business. They began operations on January 2007. They say that at the bottom of page 117 when they talk about the situation. That's fine. So the beginning balance for inventory is 0. Okay, so that would have to be given. Here they're telling you they just started operations in 2007, so they didn't have a beginning balance. It was 0. So once you know that the ending inventory is 5,000, so you can put these in. Also, if you look at the income statement information was given to you on page 118 under the weighted average method. Under the average method, they gave you on the income statement, they told you the cost of goods sold. If you look at the income statement at the bottom, page 118, the cost of goods sold under 2007 is $70,000. Under 2008, it's $90,000. Okay, so you plunk in the cost of goods sold, and you have your ending inventories. From that, you say something minus the 5,000 equals the 70,000. So I could back into this and plug it. So I know that cost of goods available for sale is 75,000. Okay, because 75 minus 5 is a 70. Once I figure that out, I can figure out my cost of goods purchased. And 0 plus something gives me the 75,000. So then I figure out my cost of goods purchased is 75,000. Same thing over here. The ending inventory for year 2007 becomes the beginning inventory for year 2008. You know the cost of goods sold. You know the ending inventory. That's given. So something minus the 9,000 gives you 90,000. You just add these two together. So the cost of goods available for sale is 99,000. You know the beginning inventory because that was ending inventory from the prior year. So 5,000 plus something is going to give me the 99,000. So you've now plugged the cost of goods purchased, the purchases, for 94,000. The reason is you need the 75,000 and the 94,000 because the cost of goods purchased, total purchases is not going to change regardless what method you're using. Whatever you purchase is whatever you purchase. That's what it costs. That's regardless of the method. So now you can figure out this 75 and this 94 then comes over to the new method. So then the new method, which is the FIFO method, they give you the ending inventories under the FIFO method. The ending inventories under the FIFO method are 7,000 for 2007, and the ending inventory for 2008 is 14,000. So this is given. The 7,000 is given. The 14,000 is given. Okay, so you put those there. Remember, the ending inventory in 2007 becomes the beginning inventory in 2008. So you put that one up here. Now that you know that, and you know that the purchases are going to stay the same regardless of the method, then you can put the 75 and the 94, which you calculated from the old method for the purchases. You put that there. And you can start backing into information, okay? You know, this is still going to be 0 because they just started business. So 0 plus the 75,000 is going to give you the cost of goods available for sale. You subtract the 7,000, that's going to give you the cost of goods sold of 68,000. So this is what you actually had to calculate, was the cost of goods sold for the 68,000. Now remember, the ending balance of inventory becomes the beginning balance in the following year. You still know the same purchases. It's the same purchases under the old method as the new methods. It's 94. So the 7,000 plus the 94 is 101,000. So you can plug that, you calculate that. Then you know the ending balance is 14,000. That's given to you under the new method. So then you can calculate cost of goods sold is 87,000. Okay, so now you know the cost of goods sold under the new method, the FIFO method, is 68,000 and 87,000. Now you set up your income statement. And this is a classic example of a multiple step income statement. We're also going to be going over this in Module 7D. You take your net sales minus your cost of goods sold to give you your gross margin or gross profit. You subtract the operating expenses to give you net income before income taxes. Then you subtract your taxes, which are 40%, to give you your net income. Sales are just sales. Sales are going to be the same regardless of which method for inventory you use. So you can keep the same numbers for sales for 2007 and 2008. What is different, though, is the cost of goods sold. You have to recalculate this. This is now under the new method, which is FIFO. So the cost of goods sold for 2007 and 2008 is going to be $68,000 and $87,000. So here's the 68 and the 87. You subtract the cost of goods sold from the sales to give you gross margin or gross profit. So that's 32 and then 43. The operating expenses are going to be exactly the same. Operating expenses are the same whether or not you use the old method or the new method. You're still saying the same cost for operating expenses. So that doesn't change. So that's the same. It's still the $17,000 and the $20,000. Subtract that from the gross margin or gross profit. That, by the way, gross margin and gross profit are used interchangeably on the exam. That then gives you net income before income taxes of $15,000 and $23,000. Taxes then 40%. You take 40% of that, which is $6,000 and $9,200, and then you get your net income, which is a $9,000 and a $13,800. Okay. Now they want you to recast what's going on here. So that's what you're doing when you're filling out the bottom page 118. They're asking for what is revised income statement. What happens is this is called what type of treatment? It's called retrospective treatment. In 2008, you just used the new accounting standard, and it's done. And then 2007, it's as if you would always use the new accounting principle, as if you would always use the new accounting principle, which is a FIFO method. That's called a retrospective treatment. You restate the whole thing, but it's called retrospective. Then, what's going to happen for the balance sheets? Okay, if you take a look on page 119. On page 119, what are they going to report for inventories? Okay, well, they're going to report inventories. The inventories were given. All right, remember they gave us the ending inventories for 2007 and 2008 under the new methods, FIFO. Should report 7,000 and 14,000. 7,000 and 14,000 for the inventories. Now, what about the retained earnings? Since they just started business in 2007, this net income gets closed into retained earnings. So the retained earnings in 2007, net income goes into retained earnings, so it's just 9,000. Then in 2008, as long as they don't pay any dividends, you just add the 9,000 plus the 13,800. When you add the 9,000 plus the 13,800, because remember, retained earnings, it accumulates. It's a balance sheet account. So you close the net income and retained earnings. As long as you don't pay a dividends, it just adds up. The 9,000 and the 13,800 is going to give you the 22,800. So it's going to be $9,000 retained earnings in 2007, but you add these together, and it's going to give you 22,800 for retained earnings in 2008. The last thing is the income tax liability, okay? The income tax liability, well, this is going to be your taxes that you're going to pay. So the income tax liability for 2007 is going to be $6,000. What's going to be the income tax liability in 2008? It's going to be $9,200? No, actually it's not going to be. What it's going to be for income tax liability for 2008 is going to be $10,000. The way you calculate the $10,000 is you take the $9,200 plus the difference in the inventories. If you look at the difference in the inventories, go back to page 118. If you look back on page 118, you have to account for the fact that you're debiting inventories, okay, by increasing the inventories for $2,000. If you look back at 2007, all right, in the middle of the page where they give you the figures for the inventories, for 2007, under the average method, the inventory value is $5,000. For the FIFO method, which is a new method, it's $7,000. It's a difference of $2,000. What you're going to be doing is you're going to be debiting the inventory to increase the inventories, okay? But then what are you going to credit? Well, what you're going to have to do is there's a difference of that $2,000, you're going to have to credit the retained earnings, okay? But that's going to be done net of tax effect. So what's going to happen is you're going to increase your retained earnings by the 60% of the $2,000, which would be $1,200, and then the 40% would be an increase in your tax liability. So your tax liability would actually be $9,200. I'll just put it right here. Your tax liability in 2008 would consist of $9,200 plus the change in inventory, which is $2,000, times the 40%, which is an additional $800, okay? And that would be plus $800. So the actual income tax liability for 2008 would be $10,000. It would be $9,200 for this year and then $800 of catch-up from last year. And the catch-up occurs because you have a $2,000 difference in your inventory. If you look between 2007, it increased from 5 to 7. That's an additional $2,000. You're debiting inventory for $7,000. You're going to credit retained earnings to increase the retained earnings by the $1,200, and the additional $800 will go into income taxes payable. Okay, because it's additional income. So that's the additional $800. All right, but that would be sort of like the entry you have to think of in your mind. It would increase. So remember, $9,200 for 2008 for income tax liability this year, and the $800 is catch up from 2007 from last year. So it's a total of $10,000. Let me tell you something. You didn't need to get that one right to pass the exam. That one was hard. If you got all the other things, you got the income statement right, you got the inventories right, okay, and you got retained earnings right, that would be enough to pass the exam. Okay? Unless, of course, you want to win the CELS Award. You know what the CELS Award is? That's the award for the highest grade, the highest score in the CPA exam. Okay? In that case, just do all the problems in the book 5 times. I'm kidding. Nobody wants to do that. I'm not trying to get you to win the CELS Award, okay? I'm just trying to get you to pass the exam. Keep that in mind. That's why we focus on all the most important things. Make sure you understand how to solve this problem. Remember, the strategy is to go from the old method, take information that carries over from the old method to the new method, then fill out the income statement. Remember, what's the information that stays the same, what information is different. Recast the statements. That's called a retrospective treatment. That's what you do in a change in accounting principle. Hopefully that made it a little bit clearer for you. It's different when you do a problem than just from reading it in the handout. Okay, I'll see you then in Module 7D, and we'll talk about the income statement and the balance sheet. See you then. Bye.